The national portion of the life insurance exam heavily emphasizes policy replacement regulations because they represent the front line of consumer protection. When you encounter questions about replacement, you must first identify what qualifies as a replacement action. It is not just the total surrender of an old policy. It includes cases where a policy is converted to reduced paid-up insurance or where the face amount is significantly decreased. Examiners love to use trick scenarios where a client uses a policy loan from an old contract to pay for a new one. In the eyes of the law, that is a replacement and must be handled with specific disclosures. Your responsibilities as a producer are non-negotiable. You must submit a statement signed by both the applicant and yourself as part of the application process, indicating whether replacement is involved. If the answer is yes, you must provide the notice to applicant regarding replacement. This notice explains the potential disadvantages of replacing a policy, such as the start of a new contestability period and a new suicide clause. This is a common exam point. Always remember that the replacement starts the clock over on these two provisions, which could leave a client vulnerable if they were to die shortly after the new policy is issued. The replacing insurer must maintain copies of the replacement notice and all sales proposals for a minimum of 3 years, although some states require 5. For the national exam, knowing that the record keeping is a requirement of the insurer is the key takeaway. You might also be tested on the duties of the existing insurer. Once they receive the notification of replacement, they have the right to provide the policyholder with a summary of their existing coverage to show why keeping the current policy might be more beneficial. This is the conservation effort. Watch out for questions regarding direct response sales. In cases where no agent is involved, the insurer must still provide the replacement notice to the applicant. The burden of disclosure does not vanish just because there is no producer in the room. If you encounter a question about the free look period for replacements, look for the answer that specifies an extended time frame. While a standard policy usually has a 10-day window, a replacement policy often requires a 20 or even 30-day period, depending on specific state regulations adopted from national standards. This extra time is the primary mechanism for protecting a client who might have been pressured into a quick decision. A great mental shortcut is to think of the replacement process as a transparency mandate. Every action taken by the producer and the company is designed to ensure the client knows exactly what they are giving up. If a question asks what the producer should do first, the answer is always focused on disclosure and obtaining the signed notice. You should never advise a client to cancel their old policy until the new one is officially issued and delivered, as this prevents a gap in coverage. This gap is another trap examiners use to see if you understand the risks involved in the transition between contracts. Finally, keep the term twisting in your mind as the ultimate prohibited act. It is the use of misrepresentation to trigger a replacement. If the comparison between the old and new policy is not fair and complete, it is twisting. By keeping the sign "before you resign" mnemonic in mind, you will remember that documentation always comes before the transition. This focus on timing and full disclosure will help you navigate the trickiest questions on the national exam.